Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we're here to talk about a topic that is very, very important in my opinion. As my 16 years of experience as a market strategist, working with thousands of retail and institutional investors over that time and seeing just about every single possible trading strategy under the sun and seeing successes and seeing blowups. What I attribute successful traders to everyone else. And today we're here to talk about that. And for those of you that have been a member of OptionsPlay or you've seen my education before, you may have attended a session related to this in the past. And largely we're going to talk about many of the same things. But the one thing that kept bothering me over and over again as I kept teaching this topic was really some of the math behind it and convincing people why this is so important. Because most investors and traders tend to spend a lot of time on focusing on their charting, the technical analysis, their option strategies, who they follow, what news service they use. There's a lot of focus on that type of stuff. And while that's all important for success in trading, there's one thing that most investors don't spend nearly enough time on, which is risk management. And I will say that, no matter how many times I teach this topic, I always found it difficult to convince a user as to why this was so important. And it always bothered me that I lacked the proof, if you will, as to why this is so important. So today, and I've been spending some time thinking about this, and I finally just spent a few hours over the weekend sitting down, going through some of the math and trying to come up with a way to hopefully prove to investors why this one thing, which has nothing to do with your strategy, nothing to do with your indicators, nothing to do with who you follow or how your strategy works. The one thing that I think is important to helping you survive as a trader and preventing account blowups. So before we jump into this, please bring up your chat window into the bottom of your screen. I'd love to hear from investors, kind of your experience with respect to account blowups. Has anyone here blown up their accounts or come close to blowing up an account through a series of bad trades? Or maybe you just had bad trade after bad trade after bad trade, and you almost lost everything in your entire portfolio. Please type yes into the chat window if this is something that you can relate to, whether it's trading stocks, options, Forex, any market. And for those of you that say no, count yourself lucky. I would say that this is probably something that just about every single investor in some way, shape, or form goes through. And if you haven't, hopefully this lesson is all you need to learn how to make sure that doesn't happen to you. So I see a lot of yeses. And again, this is largely what I expect because I've been working with traders for the past 16 years and I have seen this over and over and over again. And unfortunately, I tend to find that investors, when they go through a streak of losers, an account blow up, something that kind of causes them to lose a lot of money in a short period of time. What investors do after that largely does not change and doesn't prevent it from happening again. A lot of investors think that when they have a string of losers, they've got a bad strategy. I have investors who will tell me, I'm canceling OptionsPlay because you've told me 4 or 5 trades in a row that didn't work. I'm going to move on to the next service. And it's this belief somehow that if you just have a better strategy, that will prevent it. And I can tell you with definitive math today as to why, if you think that your strategy is what's causing a string of losses or your account blowups, I can guarantee you it's not your strategy. So if you simply just cancel OptionsPlay, move on to the next service, or follow someone else or use a new strategy, I guarantee you that new strategy will not prevent that same account blowup if you do not follow the rules that we're going to talk about here today. So like I said, this is something that is very, very important to me. I think one of the most important things for investors to learn, yet it always bugged me that I didn't have proof as to why this was so important. So hopefully today I can prove to everyone why you have to listen to this rule no matter what strategy you use. And if you've gone through this series of losses and you're trying to figure out how to prevent it, finding a new strategy is not the answer. And I'm going to show you why. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to talk a lot about trading psychology here today. We're going to talk about math, but really, hopefully what I'm trying to do is just prove to investors as to why this is so important. So the one thing that I want to help everyone walk away from today's session is an understanding as to what is the most important yet overlooked statistic. And we're going to talk about math and statistics today that contributes to your account blowups. A lot of investors think that your account blowups is due to your strategy, or they think that they're following the wrong people or they're getting advice from the wrong place. It's not that. I will show you that it's not that. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to leverage my 16 years of experience working with investors and to show you what I have found is the contributor to your losses in your portfolio, or perhaps your account blowups, and how you can prevent it. And what I'm going to do is I'm going to start off the webinar right off with how you can do it. And then what I'm going to do is I'm going to spend the rest of the time hopefully proving to you why this is applicable to you and why this one rule is going to help prevent you from blowing up your account. And the rules is really simple. And for those of you that have been following me for a while or have seen this education, you've probably have seen this before, and you probably have seen it in other places before. But I tend to find that not a lot of people put enough emphasis on this. And the rule is simply what we call the golden rule of risk management, which is stating that you should never risk more than 1% to 2% of your total account value on a single trade. That means if you have a $50,000 portfolio, no single trade in your account, a stock trade, options trade, should ever risk more than $1,000. Meaning if that trade went the exact opposite thing that you expected to, you were dead wrong on something, that the risk that you took on that trade ended up being roughly 2% of your account and no more than that. And there's a few reasons for it. Psychologically speaking, one, I tend to find for most investors, smaller losses are much easier to let go of. It's when you really take on that big trade that doesn't go in your favor, that's when we tend to be emotionally attached. We have this attachment to being right as human beings. We certainly have an emotional attachment to being wrong, and we want to prevent that at all. By all accounts. And many times we will do very, very dumb things for our financial health to not be wrong. And many times those things that we do are actually the things that contribute to the largest losses in our portfolio. So smaller losses, easier to let go of. And this one rule will go all the way in preventing any type of account blowups. And today, hopefully, I'll be able to try to prove some of that to you. So today, we're going to talk a little bit about account blowups. And it really comes down it doesn't come down to your strategy. What it comes down to is our underestimation of the statistics that contribute to account blowups. And it's actually something that occurs in other places as well. It's not just in trading. It's the same thing in what we call gambler's fallacy. And gambler's fallacy comes from an underestimation of statistics. And many of us, if any of us has ever been in a casino or played blackjack for a longer period of time, we're familiar with gambler's fallacy. It's this idea that, hey, I've already lost 4 hands in a row. I've got to win the next hand. My chances of winning the next hand must be really high. But the reality is that it doesn't matter how many hands you've just lost. Your chances of winning the next hand is exactly the same every single time. Whether we know it or not, as a trader, we are subject to gambler's fallacy. And gambler's fallacy has a few different contributors to the losses that we have in our portfolio. But the primary thing that I want to spend our time on today is estimating consecutive losses, meaning as a trader, how many consecutive losses should you reasonably plan for in your trading? And that is truly the statistic that we want to spend some time on. And what I've struggled with historically is trying to relay the math behind this. And at the end of the day, I'm not going to be able to. It's very complicated. So what I'm going to do is actually try to prove it to you in a different way. So for those of you that have listened to me before, you've heard me talk about how to prevent large losses. And this comes down to the psychological need for traders to be right. And as traders, we want to be right, right? We don't want to be wrong. We think the stock's going to go up, but it goes down. We want to be right, right? So what do we do when we buy a stock and the stock goes down? Well, sometimes we buy some more. We say, okay, I was wrong that first time, but I think now it's a better place to buy. So I'm going to buy some more. And then it keeps going down. And then we try to find other reasons. Now the initial reason as to why we bought the stock is completely lost to us. And we're trying to find new reasons as why we should continue to buy the stock and dollar cost average and get ourselves back to break even. And that's when we throw good money after bad money. So this is something that we do talk about quite a bit for those of you that have been with us for a while. And this is certainly one thing that is a cause for some account blowups, but that's not necessarily the only time that causes account blowups. The other thing that we want to talk about is a large number of consecutive losses. How many of you here have suffered through a large number of consecutive losses? And if you have, please, you want to share with us the number of consecutive losses that you had in a row? Was it 5, 6, 7, 10, 12, 14? I'm seeing some numbers here, and these same numbers, one of the things that we should think about here is, there was a great experiment by a Stanford professor once. He told everyone in his class to go home, and they had a choice. They can either flip a coin 200 times and note how many times each heads and tails, or they can just randomly pick heads and tails on a piece of paper. And he said that he was going to be able to tell who randomly just wrote on a piece of paper heads and tails, versus the people who actually flipped the coin 200 times. And you know what the difference was between the students who actually flipped the coin 200 times versus the students who just wrote heads and tails randomly on a piece of paper? He was able to tell because of the number of times someone wrote 8 or 9 consecutive heads or tails on that piece of paper. Because when people think how many times 8 or 9 tails are going to show up in a row and within 200, they always underestimate how many times that's going to come out. Versus when someone flips a coin actually 200 times, they're almost guaranteed to have one string of 6, 7, 8 consecutive losses in a row. And this is what we want to talk about here today, is the large number of consecutive losses and how that contributes to your account blowups. So this is really where I talk about something that, for those of you that have listened to me before, the idea of finite versus infinite game. Because the person who wrote this book, Finite versus Infinite Game, his name was James P. Carse. He was a professor he was a religious philosopher, nothing to do with finance or business, but he theorized that there's 2 types of games, finite and infinite games. Finite games are games that we're all familiar with, games that have a fixed set of rules. The game ends at a certain point, and at the end of the game, you're declared both a winner and a loser based on that game. Examples of this are like football, basketball, chess. These are games that we're all familiar with. And then he theorizes there's another type of game called infinite games. These games have no agreed upon rules, and they simply never end. And when you play an infinite game, there's no winners or losers. There are either players in the game or people who are, entities, if you will, that drop out because they no longer have the resources to stay in the game. That's an example of an infinite game. So an example of that, I think one of the best examples of that is running a business, right? Running a business is an example of an infinite game. It's a game that never ends. There's no rules to it. You're either in business or you're out of business. Think of trading like that. There's no end to trading, right? There's no goal in trading. You either have enough money to stay and continue trading, or you've blown up your account and you no longer have the resources to continue trading unless you deposit more money. Right? Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So a lot of investors think of trading as winning and losing. You think about the trades that you win, you think about the trades that you lose on. But that's the wrong way to think about it. If you cannot think of trading as a finite game, you have to think of it as an infinite game. And this is the part that I find most investors, especially the first time you learn about this, that you struggle to wrap your head around. And I certainly understand it. And this was the part that I struggled with how to communicate this to investors, how to communicate this to you so that you understand how do I think an infinite game? And this is really where we think about consecutive losses. So I want to ask the audience here, what do you think is the probability of having 7 losing trades in a row? What do you think is the reasonable probability that you're going to have 7 losing trades in a row? You can type it out into the chat window. Is it 5%? Is it 2%? Is it 40%? Oh, there's a lot of interesting numbers here. Some numbers that are actually much higher than I was expecting. Some people are saying 50, some people are saying 25. I see some people saying 2%, some people saying 0.5%, 5%, not much, 1%. So the numbers are quite all over the board, but it tends to skew towards, I would say, and Fernando has a great answer. And he has the answer that I think a lot of investors, he said 0.5, which is the probability of let's say flipping a heads or a tails raised to the 7th power. And that's exactly how you would think if you were playing a game, right? Of having 7 losing trades in a row. But the answer actually depends on how many trades are you going to make. If let's say you are only going to make 7 trades, and that's going to be the end of your trading career, then Fernando, you are absolutely correct. Your chances of having 7 losing trades in a row is 0.5 raised to the 7th power. 50% multiplied by 50% multiplied by 50%, 7 times over. And that number is a pretty small number. It's significantly less than 1%. But ask yourself, is your trading career going to be over after 7 trades and that's it? Is that the game that you're playing here? If that is true, then you're absolutely right, Fernando. But guess what? You're not playing an infinite game. You're playing a finite game. You're basically saying that after 7 trades, I'm done with trading, and I have to make sure that I come out of those 7 trades as a winner and not a loser. Does that make sense to everyone? That that's not the game that you're playing, yet most investors tend to think in that particular mindset. But the reality is that you're not just going to make 7 trades. You're not just going to make 70 trades. You're not likely just going to make 700 trades. You're going to make, just think about it, an almost infinite number of trades. And when you think about an infinite number of trades, what you start to realize is that 7 trades here or there doesn't matter. And what it really changes is the statistics and the probabilities around having 7 losing trades in a row. A lot of investors think of having 7 losing trades in a row as this kind of a death sentence. It's really not, especially if you understand how to think about this. So ask yourself, do you plan on only making a finite number of trades? The answer hopefully is no. The answer is hopefully no. I want to continue trading until the day I die. At least that's how I feel. Maybe not everyone does. But the way I think about this is I'm going to make millions of trades, right? So when you think about what is the probability of having 7 losing trades in a row, the answer is that depends on how many trades you're going to make. And this is really where, when I looked at the math and trying to explain this to someone, I found that I was never going to be able to communicate the math to someone. So what I did is I did something I think a little better. I basically created a way to show investors what is the actual probability of having a large number of consecutive losses within a large number of trades. So here, what I did is this page, this Excel spreadsheet, which I'm going to give access to everyone after today's session. What it does is it runs 1,000 trials of 200 coin flips. And then what it does is simply tracks the highest number of consecutive heads across each trial. So it flips the coin 200 times and it figures out how many times you have a consecutive number of heads. It counts that and it does that 1,000 times over. So I asked the question before, how many times, what do you think is the probability of having 7 consecutive losses in a row? And Fernando said 0.5 to the 7th power. And that's exactly what this number is, 0.78%, right? Less than 1% chance of that happening. But again, does everyone understand that that's only the probability of having 7 consecutive losses in a row or 7 heads in a row if all you are doing is 7 trades and that's it and you're done? Does that make sense, everyone? Please type 2 into the chat window. That's what this statistic tells you, 0.78%. So a lot of investors have in their minds that for me to lose 7 trades in a row, that's not going to happen. It's going to be so rare for that to happen. But what we're actually going to do here is we're going to run a bunch of trials. As you can see, I have trial 1 through 1,000 across the top of my page. I have 1,000 trials. And within each trial, what I have here is I have effectively 200 coin flips, as you can see, going down the list. And on each coin flip, it's a completely random selection between 1 and 0. And what I'm doing is I'm tracking the number of times that I have consecutive, the same one before the one before. And every time that it flips from heads to tails or tails to heads, it resets the counter to 0. And all I'm doing is I'm counting the max number of consecutive heads in this trial. And I'm doing 200 coin flips over 1,000 times. And what you start to see here is that, and I'm going to unhide this for now. So a lot of investors think that, okay, 5 losing trades in a row, that means that I only have about a 3% chance of that happening. 6 losing trades in a row, 1.5%. 7 losing trades in a row, less than 1%. But when we look at the actual trials of doing this 1,000 times, here's the actual number of 7 consecutive heads in a row out of 1,000. It's 560 out of the 1,000 trials that we did had at least a 7 heads in a row. That is a statistic of 56%. So let me put this into context. If let's say you were to do about 200 trades a year, what are just the chances that if you are right about 50% of the time of your trades, let's say you win 50% of your trades, what is the chances that you're going to have 7 consecutive losing trades in a row? The answer is it's about 56% of the time. And again, this goes back to the gambler's fallacy, right? A lot of investors think that I've lost 4 trades in a row. I'm sure I'm going to get the next one right. The reality is that it doesn't matter how many trades that you've just lost in a row. The next trade has the exact same probability of you being right on it as whether you've had 6 losing trades in a row or 6 winning trades in a row. That's the gambler's fallacy. And the reality is that when you have an almost finite, infinite number of trades, and we're not even talking about anywhere close to infinite, I'm just talking about 200 trades, right? 200 coin flips here. What is the chances that you're going to have 7 consecutive trades in a row? The answer is 56. And you can do this over and over again. I've made the spreadsheet that you can easily redo this. You can rerun these trials over and over again. This just by pressing the F9 button, refresh button, you're able to run 1,000 trials in about a second. And it counts the number of times that out of the 1,000 trials, how many of them have at least 7 consecutive heads in a row? As you can see, every time I run this, the reason I'm doing 1,000 trials is so that you can see how stable this number is. It's always around 550, 520, 540 out of the 1,000 trials will have 7 consecutive losing trades in a row. What that means to me as a trader is that you have almost a 50-50 shot in a single year. Let's say you do about 200 trades a year. Some of you may do more, some of you may do less, but I think 200 represents a fairly active options account. So if you have a fairly active options account, you have almost a slightly better than 50-50 shot that you're going to at some point in the year suffer through 7 consecutive losses in a row. So you have to ask yourself, if there's almost a 50-50 shot of that happening, and let's make it even better, let's do 6 consecutive losses in a row. There's an 81% chance that you will have 66 losing trades in a row if your win rate is about 50-50, right? And I'm saying, and I'm sure some people will say that trading is not a random process. It absolutely isn't. But if you have a 50-50 chance of winning, these are the statistics of your chances of having 6 losing trades in a row. And some people will say, well, I win 60% of the time or 70% of the time. That's not the point. The point is that most people vastly underestimate the probability of having consecutive losses in a row. And what we do when we underestimate the probability of having consecutive losses in a row is we tend to risk a lot more per trade. We tend to risk 4, 5, 6% of our account per trade. And this has one effect. And I'm going to show you the one more thing in my spreadsheet. If let's say you have let's say you risk 2% of your account per trade. What that means is that you have an 80% chance that you're going to lose roughly 12% at some point in that year. Okay. Now, if you've lost 12% of your total account in a bad month, well, you need about a 13.6% return to get yourself back to break even, or about 6.8 trades, consecutive wins, if you will, after 6 consecutive losses to get yourself back to break even. Now, that is an amount that's somewhat manageable for most investors. However, I tend to find that most investors underestimate this statistic and will say that, well, you know what, I'm comfortable risking 5% of my account per trade, because guess what? Any one trade takes up 5% of my account. I'll deal with that, right? But here's what I'm showing you is that if you risk 5% of your account per trade, you have about an 80% probability, almost certainty, that at some point in the year, you're going to suffer through a 30% drawdown. So when I've referred to account blowups in my first when we opened this session, most people may not consider 30% an account blow up, but I certainly do, because if you lost 30% some point in the year, you need a 42% return just to get yourself back to break even. That's pretty tough to do. So imagine having one bad month, losing 30%, and then having to make 42% the next month just to get yourself back to break even. That's now having 8.6 consecutive winners just to get yourself back to break even. And 5% is certainly not even the worst that I've seen. I've seen investors easily risk 7, 8, 9% of their accounts. And what they don't realize is that they have an 80% chance that if you risk 10% of your account, you're going to lose 60% of that account at some point throughout the year. That's 150% return that you need just to get yourself back to break even, or 15 consecutive winners based on the risk that you're taking to get yourself back to break even. And I see a lot of traders saying trading's not flipping a coin, it's not a random process, and you're absolutely right. This is not by any means a true, I would say, simulation of your trading, but it is a refresher on the statistics around what you need to be considerate of, which is the probability of having consecutive losses in an infinite series of trades, or an infinite series. And what I'm trying to hopefully highlight to investors is not that these are the metrics that apply to your portfolio, but just to show you how big of a differential most investors think that when you ask an investor, or ask you how many times do you think 6 consecutive heads will come in a row, a lot of investors will say only 1.5%. And I saw quite a few people off trade as had that as your answer. But the reality was that it was 80%. We're talking about almost, in this particular case, 50 times larger the actual probability. And you can do this for any number of consecutive trades, right? So if we look at 8, what happens is that this declines to 32%, right? So if you risk 2% of your account, there's a 32% chance that you'll suffer through a 16% loss, right? So about a third chance of that. So let's say if you do 200 trades a year, one in every 3 years, there's going to be a correction large enough that will take a 16% hit on your portfolio, which is going to be a bit to recover from, but 16% requires a 19% return to get yourself back to break even. That's somewhat manageable. But if you risk 50%, that's 40%. I'm sorry, if you risk 5% of your portfolio, that's 40% to get that back to break even. That's 13 consecutive winners to get there. As you can see, once you really exceed 3, 4, 5%, you get to numbers that are basically insurmountable. Does that make sense? Please type 5 into the chat meeting, into the chat meeting if that makes sense to you. Again, we know that flipping a coin is not the same as trading, but the fact of trading is that consecutive losses, when you're talking about an infinite game, happen a lot more frequently, statistically speaking, than most investors think. And that hopefully is the lesson that you're going to be able to learn here today. So when you get to 9, it's still a pretty decent chance. 19% chance. And again, you can run these trials over and over again. You're going to see it happens very frequently in the 16 to 20% chance of that happening. So meaning 1 in every 6 or 7 years, you're going to have 9 consecutive losses in a row if your win rate is about 50-50. If you have 2% of your account that you're losing, risking per trade, that's an 18% drawdown. You need about a 22% return to get back to break even, or 11 consecutive winning trades to get back to break even. But again, once you get into 3 to 4%, it becomes insurmountable. Once you get to 10 losing trades in a row, this is when it starts to get to a pretty low number, right? It's not, this is something that happens once a decade. But, if your trading career is 30 years long, something that happens once a decade is still something you have to plan for. So, how do you plan for that? Well, how do you do that? You plan for it by making sure that you never risk more than 2% of your account per trade, because even in something that happens once a decade, that's going to cost a 20% drawdown. You're going to need a 25% return to get back to break even, 12 and a half trades to break even. But at 5%, you've lost 50% of your portfolio. You got to make 100% return the next month just to get yourself back to break even. Again, insurmountable. Even 3 to 4% is challenging. 30% loss, that's going to take a 42% return, 14 consecutive trades in a row. So this is why this is the golden rule of risk management. Does that make sense? Please type 6 into the chat window if that makes sense to you. And again, as you can see at 10%, once in a decade, you're going to blow up your entire account, is really what I'm trying to show you. And you can keep doing this for whatever number of consecutive losses. And you can ask yourself, what am I comfortable with, right? What should I be planning for? So what I'm trying to tell investors is that if you have a win rate of about 50-50, then a 6 consecutive loss per year is almost guaranteed. 7, you have about a 50-50 shot. 8 consecutive losses, you have about a 30% chance of that. 9, you have about 16% chance. I always tell investors you should plan for at least 7 to 8 consecutive losses in a row in a year at some point throughout the year. How do you actually plan for that? You plan for it by risking less per trade. So again, the next thing I still want to address, because I saw a lot of comments on this, people will say, trading's not a flip coin. Trading's not random. That's not the point. The point is not that it's random. The point is that if you have even a 60% probability of winning, so look at all your trades that you've done over the last year. What percentage of them did you win? If you won 60% of them, well, guess what? These statistics are a little better in your favor, but they're still about 60 to 100 times worse than you actually think in terms of what is the probability of having that many consecutive losses. That's the lesson to learn here, not that these numbers are exactly what you will expect in your portfolio. But I tend to find that most investors have a win rate close to 50%. Some may be a little higher, some might be a little lower, but it's not too far from 50%. And each trade is a completely separate trade. One has nothing to do with the other. And you just have to realize that when you have a 50-50 chance of winning, especially if you're making a large number of trades, you're just going to have a large number of consecutive losses at some point. You're not going to be able to prevent that. So the goal here is not to prevent that. The goal is to make sure that when that happens, which I'm basically telling you is that it's going to happen, it's almost a guarantee that it's going to happen. Your goal is not to prevent it. Your goal is to make sure that it doesn't blow up your account, right? So when we talk about, consecutive losses, right? Hopefully what this proves to you is that consecutive losses will occur. And what I see investors do is when they go through a string of consecutive losses, instead of learning how to survive it, they try to prevent it. But the reality is that you're not going to be able to prevent it. You think that changing your strategy, you think that if you use a different indicator, you think that if you just follow someone that's better at trading, that somehow that this is going to stop happening. And the reality is not. And if any of you have churned through different services, you probably know this. I have seen traders in their lifetimes subscribe to one service, follow them for a while, it works until they hit the string of losers. They kind of blow up their accounts, and guess what they do? They cancel that service and they move to the next service, thinking that that person that they used to follow, that service that they followed, was really crap and they need to find someone better. They follow someone better, and maybe that person's better or worse. It works for a while, and same thing happens again. At some point, you hit this string of losers, and if you don't size your account appropriately, that's going to blow up your account again. And instead of saying, "How do I survive these?" People, what they do is they keep going out there and they do another strategy, or they learn another strategy. They think the strategy I learned before sucks. And they keep going from one strategy to the next, the next, the next, the next. And that is just going to keep going on forever, because again, the statistics prove to you that the chances of having these number of consecutive losses is almost guaranteed. You cannot get away from it. If you think that somehow this new magic strategy, that something that you just don't know yet is going to help you do that, the reality is that that's not the case. The reality is that professional traders that are successful, are not good at preventing consecutive losses. What they're good at is preventing it from blowing up their accounts. And the good news out of all of this is that to do this requires no understanding of strategies, no understanding of markets. It just requires an understanding of statistics and basic math. The basic math is that if you have a small loss each time, even if you have a large number of consecutive losses in a row, guess what? Yes, it will take a hit, but you can recover from that. What you cannot recover from it is when a small number of trades, because you risk too much, blows up your entire account. It takes so long for you to get to recovery that before you even get to that recovery, you're going to go through that same loss here again. It has nothing to do with your strategy. All has to do with statistics. And the good thing about that is that once you understand the statistics, when you understand basic math, you can prevent it. That's the good news out of all of this. And I hope that this gives you some sense of how and why this happens. And again, this is something that is hard to wrap your head around. So hopefully this gives you a little bit more insight into that as to the math and the numbers behind it. And I'll give you the access to these spreadsheets that you can run these trials yourself and try it out and see for yourself. You can look through my formulas. They're really quite simple for anyone who's used Excel spreadsheets before. And the one thing that I'll teach investors is that we have a risk and investment calculator on OptionsPlay. So for any strategy that you're trading, you can always use the risk and investment strategy, a risk and investment calculator, which is the third dot from the bottom of your screen. And you want to make sure that you click on I want to risk and put in the appropriate number. Let's say you have a $100,000 account, so you cannot risk more than $2,000 per trade. Well, OptionsPlay will actually do the math for you and calculate the number of contracts that you can purchase. You can only purchase one contract of this call option, but you can purchase 2 contracts of this debit spread, because as you can see, the max risk of one contract here is $1,000. If you traded 2 contracts, you would go over your max risk. If you traded 2 contracts of the debit spread, you would only risk $1,700 under your $2,000 threshold. If you do this every single time you place a trade, even if you have 6, 7, even 10 consecutive losses in a row, guess what? You're going to be able to survive that, and you're going to be able to keep trading. But if you don't follow these rules, you are guaranteed to blow up your account, which puts you out of the game. You're done. You are out of business, is the best way to put it. And what you're trying to do as a trader is to make sure that you stay in business. And the best way you can do that is put the statistic and math on your side and just continue to work on your strategy. And don't give up on your strategy because you have a string of losers. I see too many investors, the second they see 6, 7, 8 consecutive losses in a row, they think to themselves, my strategy sucks. The indicators that I use sucks. The person that I'm following sucks. Those are rarely the problem. Because statistically speaking, it's almost guaranteed that you're going to have a string of losses in your trades, especially over a larger number of trades. The higher the number of trades you make, the higher the probability you're going to come across that string of losers. So again, stop trying to prevent those string of losers. There's nothing you can do to prevent it, but you can prevent that from blowing up your account. So you just have to go back to this chart. I'll put this chart up here on your screen here one more time. You have to think about, and I mean, calculating 2% is something anyone at the calculator can do. You just put in your account value, plug in the number, figure out what 2% is, and every single time you place a trade, have the discipline to only risk that amount. And what that means is, let's say you have an account, you have a $25,000 account, and you know that the 2% rule for you is $500. What does that mean when someone says that you should look at buying this Disney 175 call option? Should you, for that, because the minimum trade is $1,000, go ahead and place that trade because it's the smallest trade that you can make? The answer is no. If you can only risk $500 on a trade, and there's a trade out there that risks $1,000, you should not trade it at all. You should look at trades that have risks for a smaller amount. I recently recorded a video on how to grow a small options account. I encourage that you watch it because I talk about some of the strategies that you can use to find trades using our credit spread report to find trades that are suitable for a smaller account. Go and do that. If you risk more than 1 to 2% of your your portfolio, I guarantee you that you will have some big losses at some point through your trading year, and that could cause you to go out of business. And our goal is to help you prevent you from going out of business. So remember, as a trader, you're playing an infinite game. Focus on the big picture. Don't focus on small wins and losses here and there, because that's virtually inconsequential in the long run of your trading career. Focus on the infinite game. And when you focus on the infinite game, you realize that consecutive losses happen far more often than you think. And hopefully today, those spreadsheets will prove to you just how more frequently they happen than you might think. So with that knowledge in mind, knowing why you risk 1 to 2% of your account per trade, a lot of investors think I'm not doing enough when I'm only risking 1 to 2% of my account. Make sure that you realize that these rules are in place for this very reason of what you learned here today. And the goal here for all of that is to help you survive those consecutive losses. Again, you can't prevent the consecutive losses. What you can prevent is your survival of them. So cut your losers. And remember, a lot of investors have trouble cutting their losers, but just remember, every single loser is only going to be 1 to 2% of your account. And I promise you will survive a loss that's 1 to 2% of your account. No matter what you think, no matter how bad a loser looks, right? You will survive. It doesn't matter if you place the trade and 2 seconds after you place that trade, the stock went against you. And I know everyone that's traded long enough feels that. Sometimes it just feels like the second you place the trade goes against you. Doesn't matter. Cut your losers. It's 1 to 2% of your account. You will survive. But what you will not survive are account blowups. And account blowups happen when you don't cut your losers, and they happen when you risk more than 1 to 2% of your account. You do it over and over again. And when you hit that string of consecutive losers, or if you have a loss and you can't let go of it, and you keep throwing good money after bad money, that's when we have big losses in our portfolio, or we let a string of consecutive losses trigger a massive loss in our overall portfolio. And at the end, and the last thing I'll say for investors is that if you're going to spend time managing trades, manage your winners, not your losers. Cut your losers. Focus your time on managing your losers. And I have a separate webinar that I've recently hosted on that if you want to find out more. So lastly, what I'll leave you with is this spreadsheet. If anyone wants to audit the spreadsheet, you want to take a look at these statistics, you want to look at the numbers, feel free. You can download the spreadsheet using the link here on your screen. I highly recommend it. And I hope that this gives you some visibility, some understanding as to just how frequently account blowups happen. And stop trying to prevent it, because you're not going to be able to. But what you can do is prevent it from blowing up your account. And that's why these rules are in place. So with that, thank you so much. I hope that this was helpful in giving you a better understanding as to the statistics and math behind it. And, I've taught this lesson a dozen times to members. And it's always bothered me that I can't prove to investors why you need to use this rule. And I constantly get challenged by investors as to why this rule is so important. And it's always bugged me that I couldn't prove it to investors. So hopefully today, and unfortunately, I find that I can't prove it to investors until they go through it themselves. And even then, I see a lot of investors who go through it not realize that this is how they could fix it. Most people think that I had this string of 7, 8 losers. I got to fix my strategy. I got to find a new strategy. Your new strategy is simply not going to prevent it. But when you stick to these types of rules, you can make sure that when it happens, that you don't blow up your account. So with that, thank you so much. What I'll do is I'll open this up on for Q&A. There's a Q&A section, and there is a chat window. If you don't mind, type your questions into the chat window, and I will try to answer as many questions as I have time for here today before I run. Jonathan, your question regarding, Jonathan, I think both Jonathan and Charles have a question regarding our accounts. Please send us an email at info@optionsplay.com. We have our customer support team on hand, ready to answer some questions. They're here till about 8 p.m. So send us an email at info@optionsplay.com regarding your account, and we'll look into that for you later tonight. Wayne, I know you've been a member for a long time, so I know you've seen a few of these sessions before. Hopefully today gives you a different aspect and different view into, what I still think is the most important lesson that traders have to learn. It's not your indicators, it's not your strategy, it's this. If you don't learn this, I guarantee you, you will blow up your account. Maybe not today, maybe not tomorrow, but at some point. Jonathan said, I did a vertical call based on your calculator, but I own 100 shares also on the same, and now I'm in a covered call. Did I do something wrong? Jonathan, it's hard for me to answer that question without understanding the details of what you traded. So you can send us an email at info@optionsplay.com and we can help try to dissect that. Recently, it has become difficult to get into the sessions due to having to go through Zoom rather than the past. When clicking on the link today took me directly to the webinar. Why did this change, and how we can get back to the direct old way? Wayne, you still have the Zoom link. So you will get the Zoom link at the same time as you get the reminder email. So you actually get two emails. And the reason we do this is because some people have trouble getting in through Zoom. So we offer you both options. I know Zoom is probably preferred. So, you get the Zoom link about an hour before each session. So make sure you check your email for that. If you have the capital to invest, you just do cover calls and cash secured puts. Is this better odds? So, cover call, is this better odds? I guess the question is it better odds than what? Cover calls and cash secured puts, both strategies have a fairly strong, probability of success. Both are pretty strong strategies, actually. They're actually strategies that have largely higher probability of success than most strategies. But I guess the question is compared to what? Will I get a copy? Yes, everyone will get a copy of the recording as well as a copy of the slides. And you can visit this link if you want access to the spreadsheet that I just showed everyone. When call or put options, should I use stop or limit order? So stops and limit orders has nothing to do with calls or puts. And, you should always use limit orders to get into the trade. You should always use stop orders. Stop orders are to get out of a trade at a loss. Limit orders is to get out of an order at a gain. Sean, thank you so much. I really appreciate it. Are the odds the same when you own the stock as buying a cover call? So, I would say that when you buy the stock, your odds are pretty close to 50-50. When you're selling a cover call, your odds improve by a little bit because you're collecting some premium, and that lowers your effective net cost basis on the long stock. So by selling the cover call, you're going to have a higher probability of success than if you just buy the stock. Or trailing stop to protect the options trade. So if you're trying to protect an options trade, you're going to have to use a stop loss order. A limit order is for you to take profits. The 2% rule only applies to amount allocated to options, right? Generally speaking, yes. I would say that if you're trading stocks, you can find that you can use about 5% of your portfolio per stock. But when you're trading options, no more than 2% of your account per trade. Jonathan, I went to school, applied math and stats. Thank you. This makes more sense than any other site in your info. Thank you so much, Jonathan. I knew that this was an important lesson, but I've always struggled with how to communicate the reason as to why, because I couldn't exactly go through the math. It gets a little too complicated. So hopefully by showing you, this is a little easier to understand. How many trades do you have open at once? That's a great question here. So if you follow the 2% rule, how many trades can you have open at once? I generally tell investors no more than 5 to 6 open trades in a row, 5 to 6 open trades at a time. I tend to find if you go beyond that, you will have, because here's the thing, right? If let's say you have 10 open trades in a row, and let's say all 10 trades are long stocks or long some type of stock or ETF, then when the market goes down, 1 month, let's say you have a bad month, maybe the Fed raises interest rates suddenly and the markets are down 10% a month, and you have 10 open trades in a row, that's not really risking 2% of your account per trade. That's like risking 20% of your account per trade. So you have to factor that in, right? Because just because you're trading, you're risking 2% per trade, but you're trading all at the same time, that doesn't quite fix the problem so much. So keep those things in mind, that you can't just have 1,000 open trades at once if you only risk 2% of your account per trade. Does your platform show more advanced strategies like iron condors? Yes, we have pretty much every single strategy you can possibly think of. You just click on the modify button. We have the strategy constructor. So if you want to use neutral strategies like a call condor, a put condor, an iron condor, these are all here, and you can create one at the click of the mouse. You can create the wingspan, the widths. You can do this all by the click of a mouse. You can move the strikes up one, down one very quickly using our strategy constructor. For those of you that are having trouble getting into the sheets, know that we are working on a better solution where we're actually going to have them directly on a table, that you don't need any Google Sheets or anything like that to access. We are working on a better solution that should be out in about a couple of weeks. I just saw that completed in one of our development environments. I've made a lot just selling cover calls and cash secured puts. I just figure out what I'm willing to buy or sell at a stock and stick with them. Sean, perfectly good strategy, and I'm glad you're able to share your success with us. Short straddle, I closed both legs separately with profit, but account balance, my account didn't increase with that profit. So, if you have a question with your brokerage account, the best place to contact is your brokerage account. Unfortunately, we won't be able to solve that problem for you. Thank you for the statistics today, Tony. This helps not feel so bad about myself after a recent losing streak. I've been focusing on practicing my risk management now. Super glad to hear that, Super G. Hopefully this illuminates just how frequently, or not that how frequently, but just how statistically, the chances of having a fairly large string of losses that most investors consider as a death sentence. The reality is that it happens far more often than you think, and your job is not to prevent it. Your job is to, which is going to be a lot harder, to figure out some type of strategy. It doesn't have a large number of consecutive losses. I can tell you that's much, much harder than sticking to 1 to 2% of your account per trade. How to calculate and assume risk for cash covered puts. The OptionsPlay tool does that for you, right? You can look at an income, you can look at your max risk and max reward on a cover call or cash secured put. It does the work for you. I don't want to get into the math right now. If you really want to get into it, you can Google it, but I don't think most people want to. Our platform just does the math for you. My problem is that each day I can make profit from several trades. However, the amount to lose is bigger, so I always lose each day. Well, I would say then you have to look at your strategy. You have to look at where are you taking losses? Where are you taking profits? I tend to find that some investors will take profits too quick, and they'll let their losers go far more. That's a completely different problem, right? If you're making lots of day trades a day, you have to make sure that the expected return of your strategy is positive. So I will say that if you're struggling with that, I do encourage you to look at my recent session on growing a small options account. In that strategy, I talk about one single strategy, credit spreads, that you can use to potentially, hopefully, learn to stabilize those profits and losses and get yourself just to break even first. I think a lot of investors struggle just to get to break even. Hopefully, I think we have a good way to show you how to get to break even and then show you how to improve and get to profitability. Hi, Tony. For the 2% risk, my attempt is always to look at the risk first between the strategy I want to apply. Am I doing the right thing? For example, debit versus credit spreads. Even though I know a stock is going to rally, I will still pick the 2% risk. So I wouldn't compare strategy to strategy, because debit to credit obviously has different risks, right? But it's the number of contracts that you trade. You can trade, a different number of contracts and have the same amount of risk. So I don't know, let's go to a lower price stock, like let's go to Ford, something with a lower price, right? Just to show you this concept. But when I'm comparing a debit versus a credit, yes, the debit and credit has different risks, right? So for example, this risks $60, this risks $115, but that's not really what I'm looking at. What I want to do is always plug in the amount of money I'm willing to risk. And what that's going to tell me is that I can either sell 8 contracts of the credit spread or buy 4 contracts of the debit spread, because both of them will give me roughly the same amount of risk, just about $500. So it's not about which strategy is best. It's a matter of how many contracts can you trade to have the appropriate amount of risk for your strategy. So you want to pick based on where you think the stock's going to go. If you think the stock's going to make a big move, you're probably much better off buying 4 contracts of the debit spread than selling 8 contracts of the credit spread. But you'll have the same amount of risk with both strategies if you just follow the right number of contracts to trade. So hopefully that answered your question, Chantel. I think that was a great question. Pat saying, will you have a webinar on PFOV and how it affects the prices we get? So I'll say this, Pat, and a lot of questions about payment for order flow. The reality is that the payment that your broker gets per contract is measured in pennies. So a lot of investors somehow think that payment for order flow is either good or bad for them. And I'm not trying to say it's good or bad for your order, but when you have $100, if a contract costs $300 a contract and your broker is getting paid 50 cents, it's not going to materially impact your P&L on that trade. It's just not. Like the amount that a broker is getting paid is measured in pennies, and you're usually trading contracts that are hundreds, if not thousands of dollars a contract. So, 50 cents here, 25 cents there, it's not going to have a material impact on your trading. So it does affect the prices that you get, but it affects such a small amount, it doesn't have a material impact. Tony, I'm relatively new to OptionsPlay. Can you please do a demo of the entire site? So yes, I actually have a video on that. If you want, you can find it on YouTube, which I'll post a link into the chat window at options. It's youtube.com/optionsplay, which I will post into the chat window. How do we set limits on credit spreads? So I do have a video on credit spreads. So please look at my YouTube channel. There's a video that I recently posted on how to grow a small options account, and I talk about exactly how to set limits on your credit spreads. How does the use of stop orders affect this philosophy? It really doesn't, Harley, because stop losses may prevent you from having the full loss, but you should always presume that the stop loss could get gapped, meaning you could, you think that the stop loss is going to protect you, but at the end of the day, what you really need is the limited risk part of the strategy to protect you, because you can put in a stop at 50%, but that doesn't mean that you're going to get filled at 50%. You can get filled at 60%, you can get filled at 70%, you can get filled at 100% loss. So don't let the stop loss be the only way to prevent you from having bigger losses. If you have 5 trades at a time with 2% each, this only utilizes 10% of your account. What do you do with the remaining 90% of your account? Buy stocks or keep it in cash? I think most investors like myself will allocate the majority of their wealth or portfolio into stocks, ETFs, something that can grow in the long run, and then have a smaller percentage of your account allocated for trading options. Donald, thank you so much. I appreciate that. And I'm glad they're using the 2% rule. I know that you've been with us for a while and you've learned the lesson. Hopefully you don't need a refresher on this, but hopefully this also just gives you a better understanding as to why. And I think for a lot of investors also, I think someone else said before, thank you for saying this, because a lot of investors feel that when they have 6, 7, 8 losing trades in a row, they feel bad about themselves. They feel that they're doing something wrong. And maybe you do too today. Maybe you feel that you've gone through the string of losses and you think, and you're beating yourself up over it. Don't do that, because it's not you. It's just the statistics of how it's almost a guaranteed to happen. Do you have a stop loss rule, percentage or otherwise, on stocks versus options? So for options, we always, you always have a stop loss rule for any asset class. It's just different for each asset class. Stocks, for me, I tend to use more based on technical levels rather than percentages. For options, it's almost always based on percentages, but it depends on the strategy. So if you want to learn more, you can follow us on YouTube. Find the video on the specific strategy that you're trading, and I will have rules for you. And I am doing a session here at the end of August. Let's see, what day is it? Where I'm going to do a strategy rapid fire. So a lot of people love the rapid fires where I go through symbols, but I'm going to do a strategy rapid fire where I'm basically going to go through every single strategy and just give you the rules or the best practices across each strategy. What day is that? I believe it's 2 Thursdays from today. Which would be August 26th. So August 26th, 2 Thursdays from now, I'm going to be doing a strategy rapid fire. I'm going to go through lots of different strategies and what are the best practices for each one. What's your most frequent option strategy in today's volatile environment? So I also covered this recently, on my session last week, debit versus credit spreads. There's a reason that we tend to trade credit spreads far more. And it has nothing to do with the fact that we like the strategy more. It just has to do with the fact that you're able to find credit spread opportunities far more often than you can debit spread strategies. So the reality is that credit spreads is always going to be more often that we trade that than debit spreads. If you suggest that you limit your trades to 5 to 6, how can you make a profit that warrants allocating, say, $100,000 to options trading? I'm not sure that I understand your question there. What do you mean by how can you make a profit? You can make a profit regardless of what percentage of your portfolio that you are allocating. If you do short straddle and close, both of the profit account balance should increase, right? Yeah, but again, you're going to have to talk to your brokerage firm about that in terms of what happened and why your account balance didn't change. Why aren't advanced options trades such as straddles included as recommendations on OptionsPlay? First of all, short straddles have unlimited risk. I will never put out a trade to trade something with unlimited risk for the general public, just because not everyone is as aware of the risks, and people, as much as I try to tell investors these types of rules, not everyone follows them. So that's why we never put out any strategies that have unlimited risk. We always put out strategies that have limited risk. So no matter what happens, there's a limit as to how much you can lose. We do have a straddle report. You can go to our straddle report if you want, where we find high probability strategies and straddles that generate a high amount of premium. So for those investors who are sophisticated and you want to access them, you can do it using the At the Money straddle income report. This is where we find straddles in the market that generate the most amount of income. So you can find it using the at the OptionsPlay hub, which you can find at the top of your OptionsPlay tool. With that covers the questions that I have. There's a question about if there's a session tomorrow morning. There is no session tomorrow morning, but we will be putting together a chart book for you so that you can see all the charts that I pay attention to. We're going to include, all the ideas that we have, the overall markets. I will say, generally speaking, quite a few things in the markets have improved here with respect to internals. So things look a little stronger than they did, even from Tuesday when we spoke. So we'll all include that in the chart book tomorrow morning. So with that covers what I wanted to share with you here today. Everyone who's a member will actually be emailed the chart book tomorrow morning. We have been doing it for quite a few weeks now. So every other Friday, we email you the chart book in the morning. So you'll be receiving that in your inbox at 9 a.m. tomorrow. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week on our market outlook session. Have a great night.